the big money who's been bringing in billions and billions a week in this stuff, I think they have bigger ideas and bigger plans for where silver is ultimately going to go. Let me say it one more time. The most powerful nation on the earth, the United States government, who really doesn't have much in the way of silver, who's importing billions of dollars a month, billions and billions and billions a week and month into COMEX and other areas that we probably don't even know about, including buying directly from local and artisanal mines, has classified silver as a critical mineral. What does that tell you about what the U.S. government sees in place or has in mind for silver?
Over the past several months, a clear and unusual pattern has taken shape in the silver market, one that demands serious attention. There have been consistently large flows of physical silver into major trading hubs, persistent strength in spot prices despite ongoing pressure in the paper markets, and an elevated premium between spot and futures prices, something rarely seen outside of crisis periods. Renowned bullion dealer Andy Schectman believes these are not random fluctuations or short-term arbitrage plays. Rather, he suggests they are deliberate moves by powerful, well-funded players who view silver as a strategic asset, not just a commodity. For investors, the key takeaway is simple. When major institutions start treating silver strategically, market prices begin reflecting real-world supply and demand, not media narratives. Schectman's thesis is both bold and revealing. Large, sophisticated buyers, including U.S. government agencies and major Wall Street entities, appear to be channeling vast sums into physical silver, often through established exchanges, but ultimately aiming to secure real metal, not paper claims. If this accumulation is occurring on the scale he describes, the consequences could be far-reaching. A shift from paper-based trading to physical ownership redefines market risk for both bullion holders and derivative traders and challenges long-held assumptions about the interchangeability of contracts across global vaults. Importantly, this is not mere speculation. The market itself shows clear stress signals, sharp bursts of spot volatility, repeated efforts to suppress price rallies, unusually wide spreads between regional markets, and a growing number of investors demanding physical delivery rather than rolling over paper contracts. These developments form the foundation of Schectman's argument and explain why experienced participants are paying close attention. In his latest discussion, he highlights several critical signs: shrinking silver reserves in London vaults, historic backwardation indicating urgent demand, the U.S. government's reclassification of silver as a critical mineral, and coordinated buying by major nations and sovereign funds. Schectman concludes by encouraging investors to think critically and focus on data-driven insights. The silver market, he warns, may be undergoing a transformation that will permanently alter its structure and value dynamics. If you value clear data-oriented insight, please like the video and subscribe to the channel and turn on the notifications bell for more videos like this.
It's really very unusual. Really what is so unusual, Michelle, above many other things, is the resiliency that we see with the spot price. They will, like, for example, on Friday, if I'm not mistaken, it was Friday, they knocked it down hard, a couple of dollars, under 50 into the $49 range. And just like that, by Tuesday or Monday night, last night, it was at $53.30 spot price. Now, that would have been in Asia trading. And now they've knocked it down again today, trying to mitigate its rise. And today, right now, we are, where are we? We're right around 51.60 or so, climbing back up. The strength that it is exhibiting in the face of continued attacks on it, a huge backwardation, something I've never seen before, as much as a $3 spread between the spot market, the OTC market, and the December futures contract. This shows a massive stress in the system. Unprecedented strain, to your point. It is unprecedented. And it's not just volatility, Michelle. It's kind of, to me, it's the market exposing the shortage of physical silver and the fragility of the paper promises. I think this is something that is far more than just a one-off. It's something I've never seen before. First of all, what it tells me is more than anything is that buyers aren't just rolling contracts over the way they used to. They're standing for delivery. They're demanding the real metal. And to me, the takeaway is that the rush for physical gold and silver is real, and it's intensifying. And markets just aren't trading paper contracts any longer. They want metal in hand. Now, this is multiplied by delivery strain. You and I have talked at length since November, we've seen a continual influx of metal coming into the COMEX market. And you can blame it on tariffs or blame it on arbitrage or blame it on whatever you want. I don't believe any of that. I think this is much deeper. There are people that want us to believe it's not as deep. Even the Bloomberg article that says that there are ships that are being loaded up to send silver over to London. I don't believe that at all, as a matter of fact. I think that's spin doctoring kind of to buy some time for the LBMA. If silver was so plentiful, they wouldn't need a PR scheme to tell us about the silver that's heading over there. I don't believe it at all. But when you talk about exacerbating what's happening, we've already seen almost 17 million ounces of silver delivered into COMEX in the month of October. And when you see a London spot silver price at a $3 premium to the New York futures, a spread that hasn't been seen maybe ever, at least since the Hunt brothers in 1980, and borrowing cost in London that has spiked to 100% annualized, worse than the 1980 panic. What this tells us is that the demand for physical silver at the highest level. We've talked about the central banks buying it. We've talked about China buying it and flying around the world and buying doré and concentrate. We've talked about Russia and their really massive acquisition of silver over the last 5-6 years. We've talked a lot about Saudi Arabia and their fund, who just bought a few $100 million worth of SLV. And that sucks in and of itself that it was SLV. But remember, at the level they paid or bought, they can stand for delivery. We've talked about Russia adding it to their strategic stockpile. And lo and behold, we find the United States, the U.S. government, who wouldn't know a silver coin if it fell on their foot, it seemed all of these years, have now reclassified silver as a critical mineral. They have put a floor under the price of silver. So when you put all of this together and then add into it the most sophisticated traders on Wall Street, bringing metal in at the levels that they are, that is what is driving this. And in an environment where the LBMA, according to David Jensen, someone that you need to get on our show, David Jensen is amazing. And no one talks about the LBMA backdrop the way David does. And I think it's really very important we get him on. But what he's been saying lately is that there's 140 million ounce float of silver in London, meaning that's the amount of silver backing the contracts. The other silver they have there, the other 500 million or so ounces belong to the ETFs. So the only metal that is available, supposedly unencumbered, and who knows how much of it is unencumbered, when they already told us last year that they overstated those numbers by 100 million ounces at the LBMA. But if we take them at their face value, 140 million ounces, according to David Jensen, trading 600 million ounces a day in deliverable contracts. What could possibly go wrong? We have an environment where the exchanges and the paper promises are being usurped and passed on, even at large premiums right now, where if you sent your metal, if you bought a contract on futures and sent it to London at a $3 spread, that's a big arbitrage. And there will be some players that do that. But I don't think the smart money, even at a $3 per ounce premium to send it to London, really wants to do that, because silver is becoming far more valuable than the currency that is used to buy it or to sell it. If the shorts can't deliver, Michelle, the paper game ends immediately and silver explodes higher. The day a short cannot deliver is the day that silver breaks free. No delivery, no trust. That's when silver goes vertical. And if COMEX or the LBMA fails to deliver, it's not a dip, it's a liftoff for silver. And the whole system is based upon promises to deliver. And if you can't deliver, it's the same thing as a force majeure or a default. And the whole system, which is systemically connected, the contagion that would come out of that would be extraordinary. And that is the $1 million question, and where things get really bullish for silver. So yeah, could it happen? It's never been closer to, by all appearances, to happening, and more so in London than in the COMEX.
To that end, we've got reports that metal is being airshipped between vaults from the US to the UK just to plug the gaps. What does that tell you about where we are in the cycle here?
I don't believe it. I mean, I think some of it is, yes. I think that there is some metal that is moving that way. But I think that that's more a PR campaign. I think that, yes, there's always going to be some commercial bank arbitrage that we're seeing right now, where they're able to, by sending it to London, capitalize on that spread. But I don't think that's really what is happening, to be honest with you. I think that is a PR campaign by Reuters and by Bloomberg to kind of say, hey, everything is okay. That metal, look, there is not a chance in hell that the metal can move over there fast enough to meet these demands. You're going to see lots of margin calls and unwinding of positions. And I think that it's just like they told us that silver was coming back here because of tariffs and arbitrage. I don't believe it. I think there is something much bigger at play here. And when the U.S. government reclassifies silver as a critical mineral, they're not going to be in a rush to send it over there to capitalize on some arbitrage. Yeah, you're talking millions of dollars. So what? I mean, I don't mean to say it in a cavalier manner that way, but I think the big noise about sending silver to London isn't strength. It's a cover story to calm nerves.
Andy firmly believes that the widely circulated stories about metal being flown into London are, at least partly, a public relations strategy designed to calm the markets rather than reflect true supply conditions. By creating the image of movement and replenishment, exchanges and custodians can project stability, discouraging lenders and counterparties from demanding margins that might further destabilize the system. But this need for reassurance isn't just about perception, it's about the math of physical supply. When the real metal backing paper contract starts to shrink while deliverable claims keep rising, those holding short positions begin losing the ability to meet their delivery obligations. This imbalance shows up as backwardation, rising borrowing costs, and large, concentrated deliveries that pull even more metal out of circulation. All of this tightens the physical supply chain, driving up the scarcity premium, the extra cost buyers must pay to get immediate access to real metal. Put simply, if London and New York can't convincingly prove that they still hold the quantities of silver they claim, the market could face a crisis of confidence. Paper contracts would stop being trusted promises and instead become potential legal disputes, while true price discovery would shift back to those holding physical silver. The pressing question, Andy says, is how long they can hold this system together. And his answer is not for long. He also points to the international angle. Countries like China and other major buyers are quietly bypassing traditional channels, sourcing raw silver, ore, and concentrates directly, and building their own global vault networks. This slow but deliberate accumulation strategy not only worsens the pressure on Western paper markets, but also strengthens real-world reserves in strategically chosen regions around the world.
Are there really ever coincidences anymore at these levels? You know, the United States certainly is a very, very powerful, great country, but many of the nations whom are rallying against us using commodities as a sidestep to the dollar and the treasury market hegemony, they have a say in all this too. And to your point, the Shanghai Metals Exchange, as you and I have talked about on many occasions, is not only trying to gain credibility and have other countries store their metal with them. Remember, they're in the process of building multi-jurisdictional vaults all around the world, starting first in Hong Kong, now in Saudi Arabia, and then ultimately through the Belt Road. Now, China, the second largest producer of silver in the world, David Morgan will tell you when he went to China, they tried to tell him they were number one. So number one or number two, number one in gold, yet they're flying all around the country, buying all around the world. Latin America, Peru, and Mexico primarily buying doré, which are crudely refined bars, and concentrate, the byproduct of the mining process, directly from these players, disintermediating the market, right from the miners, disintermediating the market, and sending it all the way back to China on their expense, paying double what the West will to refine it themselves. These metals are becoming very critical to them. So, yeah, why wouldn't they want this to happen? To allow the price to go much higher. And how do they do that? The same way I've been saying this since the first interview you and I did together years ago. They're draining the exchanges slowly and methodically. They're standing for delivery in London. The London Metals Exchange has the lowest amount of silver, the float, they've ever had in the 140-year history of the exchange, at least since they started keeping records. And so they have been using the idiocy of the Western suppression system to beat us at our own game. The part that most analysts and most naysayers have a hard time justifying when we say this is that they haven't done it like that. Everyone in this country expects instant gratification, and if it's not fast enough, if it's not immediate, it ain't fast enough. That's their genius. Slowly enough to not rattle the bushes. But they've done a yeoman's job at that. Look at the countries involved. Saudi Arabia, Russia, China, India. They're all accumulating silver in their own way as fast as they can, but also gold, not too fast. And many of the other nations are too. So, yes, this would indeed. And the mistake that we make in this country is thinking that we are omnipotent and we have the ability to control everything. And you know what? As I've said with you before, these countries are now sophisticated, coordinated, motivated, and they have a plan that is methodical, a plan that drives the analysts in the West nuts because it's not in your face bang. No, but take a step back. It's just like the title of my show, little by little by little by little by little, and then bang, all at once. And we haven't seen the all at once moment, but is this the beginning of it? Maybe, could be, don't know. But absolutely, to your point, this would benefit not just China, but all of the BRICS nations. To say they have a hand in all of this and to poo-poo it and say no way is as naive as a mud wall. It's absolutely, I think, very plausible that the Chinese have not only interest in seeing this, but are understanding that their actions and slowly exacerbating it ultimately is to their best interest.
Is there a way that China could physically help engineer the squeeze?
Yeah, by standing for delivery all around the world. And that's what they've been doing. I believe that they have been involved in shorting the paper price as well, because if you can't beat them, join them. And then going all around the globe in places like London, in places like Shanghai, all around the globe, including the miners directly, disintermediating the marketplace and pulling silver inexpensively at a subsidized price because of the futures leverage, because of the suppression, and buying as much as they can, anything that's not nailed down all around the globe from centers that do not trigger price discovery. It's the COMEX that triggers price discovery. And so they're using the suppression of the Western paper market and probably adding on to it in an effort to do exactly what we're talking about. Slowly, instead of suppressing the market for other gains, political or militarily or whatever it may be, dollar supremacy, bond market supremacy, pick your poison. They're doing it because they realize we are entering a period of time where commodities will define the strength and legitimacy of a nation. And those commodities are not just going to be gold and silver and platinum. Platinum's another example where the head of the TOCOM, Bruce Ikamoto, or I'm butchering his last name, but Bruce, the head of the Japanese TOCOM, says they're trading over 3 million ounces of platinum a day in London, but in, as he says, loco, meaning location, London and Switzerland, 0 ounces available. What could possibly go wrong if you're trading 3 million ounces of deliverable spot contracts a day against nothing? And the same thing is true in London. What could possibly go wrong when you have 140 million ounces with 2 billion ounces in contracts out there that could stand for delivery, not to mention the 600 million you're trading per day? What could go wrong? The Chinese have slowly played this game and buying it all around the world, including London, and they're achieving it by using our stupidity, our hubris, our suppression against us. Now, there will be some metal that will go back to London. There are a lot of players in that market, and some don't see the big picture. Some want to capitalize on the arbitrage. To the extent of what you're reading in Bloomberg, there is some truth to it. But on a big level, I don't think you'll see more than 5 or 10% of the metal that's shot back here go over there. And it will just be a few players trying to arbitrage the big money who's been bringing in billions and billions a week in this stuff. I think they have bigger ideas and bigger plans for where silver is ultimately going to go. Let me say it one more time. The most powerful nation on the earth, the United States government, who really doesn't have much in the way of silver, who's importing billions of dollars a month, billions and billions and billions a week and month into COMEX and other areas that we probably don't even know about, including buying directly from local and artisanal mines, has classified silver as a critical mineral. What does that tell you about what the U.S. government sees in place or has in mind for silver? These are the crumbs that a lot of people will just blow right past and ignore. To me, if you are a country who classifies an asset as a critical mineral, you're not going to let it all ship away. And so the majority of the metal that's come in under the guise and BS to that of tariffs and arbitrage, I believe has twofold implications. One, I think it was brought back to cover the short positions of many of the U.S. banks who are short in New York and long in London. They brought back their London metal to cover their shorts And if I had to guess, had a gun to my head, I would say they've worked out a deal to deliver that to the U.S. Treasury under the guise of the Exchange Stabilization Fund to help build a stockpile of critical minerals and elements.
After listening to Andy's insights, the first and most important adjustment investors should make is to clearly separate paper liquidity from physical liquidity. Paper liquidity can look abundant on spreadsheets, but physical metal is often tightly held, encumbered, or unavailable for quick transfer. Paper contracts are, in essence, promises that depend entirely on counterparties keeping their word, whereas physical metal requires logistics, storage, and most importantly, a seller willing to let it go. When much of the available metal is being hoarded by governments, ETFs, or strategic reserves, the margin of safety for those relying on paper substitutes rapidly diminishes. Next, it's crucial to understand that backwardation when spot prices exceed futures is not just a technical anomaly. It's a strong market signal that immediate demand is outpacing future supply. For investors and fund managers, a sustained spot premium indicates that holding allocated physical silver may provide both a real yield in delivery certainty and protection against counterparty risk. This is especially significant if, as Andy suggests, major institutions are intentionally standing for delivery rather than rolling contracts forward. Each cycle of such physical deliveries further reduces the available float that supports the paper markets, amplifying pressure over time. Moreover, Andy highlights an important geopolitical dimension. Nations like China, Russia, and Saudi Arabia are quietly accumulating silver across multiple jurisdictions. When countries begin treating silver as a strategic resource, they tend to favor domestic stockpiling and controlled distribution over short-term trading gains. This behavior can disconnect regional spot prices from global paper benchmarks, creating localized scarcity, and in turn, higher prices and increased volatility. For investors, this means it's essential to evaluate where and how their holdings are stored. Physical bullion under direct legal title behaves very differently from ETF shares or futures contracts. Finally, those considering reallocating their portfolios should take a measured, evidence-based approach. Verify the custody and ownership structure behind your holdings. Assess the ratio of deliverable metal to outstanding claims wherever possible. Consider increasing your exposure to forms of ownership that guarantee physical possession. If your goal is to hedge against systemic risk, don't view silver as a speculative trade. Treat it as a form of portfolio insurance whose value rises precisely when confidence in the paper system weakens. If you found this breakdown helpful, please like and subscribe for more data-driven analyses that go beyond headlines and uncover the structural forces shaping markets, returns, and risk.